In today's video, we're going to talk about internal range liquidity and external range liquidity. But in this lesson specifically, we'll focus on trading these internal range liquidity when price is either at the high of the day or the low of the day. Let me show you a visual example of what I mean. Here you can see our internal range liquidity. The idea is simple. We wait for price to return to that internal range liquidity, but it must return at the high of the day. When that condition is met, it significantly increases the probability of the trade. So when price taps back into internal range liquidity at the high of the day, that's when we look to take our trade. In a bullish scenario, we want price to return to internal range liquidity at the low of the day. If it's not at the low of the day, then we simply don't take the trade. That's the core idea behind this strategy. Now let's go through the checklist. There are 4 simple rules. First, price must be inside a 4-hour internal range liquidity. Second, when price returns to that internal range liquidity, it must be at either the high of the day or the low of the day. If you're bullish, price needs to return to that bullish fair value gap at the low of the day. If you're bearish, price must return to the bearish internal range liquidity at the high of the day. Third, we wait for a 15-minute market structure shift, and then we wait for price to return to a PD array it left behind. Fourth, we target a 1-to-2 risk-to-reward ratio. That's it. We're only using 2 time frames, the 4-hour for internal range liquidity and the 15-minute for execution. Now let's go through some examples. The first example happened on the 19th of August, 2025. On the 4-hour time frame, we had internal range liquidity. Price returned into that zone. On the 15-minute chart, you can see price came back into the 4-hour fair value gap, and importantly, it did so at the high of the day. That satisfies our second rule. Next, we wait for a 15-minute market structure shift, which we got. Then price returned to a PD array, in this case, a fair value gap, which becomes our entry. Stop loss goes just above the high, and take profit is set at a 1-to-2 risk-to-reward ratio, and you can see how the trade played out. Now, the second example happened on the 20th of August, 2025. Again, we had 4-hour internal range liquidity, and price returned to it at the high of the day. However, we did not get a clear 15-minute market structure shift. Since the checklist was incomplete, we skipped the trade. Discipline is key. The next example occurred on the 21st of August, 2025. Price returned to the 4-hour internal range liquidity at the high of the day. However, we still did not get a proper 15-minute market structure shift before the move. According to the checklist, that means no entry. Now, this is where discretion can come in. This checklist is a framework. You may find ways to refine entries further, but the structure keeps you disciplined. Even so, you can see how price respected this fair value gap and continued its bearish move. Now let's move to the 25th of September, 2025. We had our 4-hour bearish internal range liquidity. Price returned to it at the high of the day. Then we got our 15-minute market structure shift. After that, price returned to a PD array, which became our entry. We target a 1-to-2 risk-to-reward ratio, and the trade played out perfectly. Next example, 27th of January, 2026. Here we had 4-hour internal range liquidity, and this time price returned at the low of the day, satisfying the rule for a bullish scenario. We then got a 15-minute market structure shift. Price returned to a PD array, in this case a breaker block, and we target a 1-to-2 risk-to-reward ratio. Another clean setup. Now the 3rd of February 2026, again 4-hour internal range liquidity, price returned at the high of the day. We waited for the 15-minute market structure shift. Price returned to a PD array, which became our entry, and we target a 1-to-2 risk-to-reward ratio. It played out exactly as expected. Then on the 19th of February 2026, we saw the same sequence. 4-hour internal range liquidity, return at the high of the day, 15-minute market structure shift, return to a PD array, in this case an order block, target a 1-to-2 risk-to-reward ratio. Again, the strategy delivered. Now, one very important thing I want you to understand, no strategy works 100% of the time. Some of these examples were selected to clearly show you how the model works. There will be losing trades. That's part of trading. Forex is a game of probabilities. If you apply this strategy correctly, stick to proper risk management, and aim for at least a 1-to-2 or 1-to-3 risk-to-reward ratio, without sabotaging yourself or trading emotionally, this strategy can make you consistently profitable over time. That's all I have for you today. By the way, I created a PDF for this teaching. Click on the first link in the pinned comment to download it. If you found value in this video, give it a thumbs up and subscribe. I'll see you in the next one.